Hi everyone, good morning. Myself Ranjit. Welcome back to my YouTube channel. Today we are going to discuss exit strategies. Before we are going to the topic, please subscribe to my channel. Okay, let's go to the topic. Whenever you are considering a trade, three factors must be crystal clear in your mind: way to get in, way to take profits, and way to bail out in case of an emergency. Daydreaming about profits will not make you rich. You must decide in advance where you will take your winnings off the table or cut and run if the market turns against you. Beginners keep looking for promising trades and assume that finding them will make them money. Novices search only for entries while professionals spend a lot of time and energy planning their exits. They always ask themselves where to take profits or cut losses. Survivors know the truth. You don't get paid for entering trades. You get paid for exiting profitably. Why think about an exit even before you enter a trade? Isn't it better to get in, monitor the trade, and exit in response to price action? There are two main arguments for deciding on an exit before entering a trade. First, knowing your targets and stops allows you to weigh rewards and risks. If you have a clear signal to buy with a price target of 100 rupees above and a stop 200 rupees below, is such a trade worth taking? Do you want to risk of 200 rupees to gain 100 rupees? Price targets and stops prompt you to focus only on such trades whose potential rewards for outweigh the risks. Second, setting profit targets and stops before entering trades helps sidestep to the pernicious ownership effect. What happens if a batsman is unable to make runs and is bogged down in a one day cricket match? He either tries to rotate the strike to the other batsman by taking singles or gets out. If instead he remains at the crease and is also not able to score runs, the asking rate will keep on rising and other informed batsmen will not get a chance to bat. You need to decide on exits before you enter, before a trade becomes yours. Exits are a distinct part of technical analysis called a trade management. A good entry into a trade is only 25% of the job, albeit a very important one. The part that helps you make money is trade management. Most successful traders make most of their money from very few trades. So once you are in the right trade, it is critical to manage it well in order to get the maximum profits out of it. Here are some exit rules you can follow. Place your stop the moment you enter a trade. A stop will not protect you from a bad trading system. The best it can do is limit the damage, even though it does not always work. A stop loss order limits your risk. It is not a perfect tool, but it is the best defensive tool we have. When you go long, place your stop below the latest minor support level. When you go short, place a stop above the latest minor resistance. Avoid all trades where a logical stop would expose more than 2% of your equity. This limit includes slippage and commissions. As soon as the price starts to move in your favor, move your stop to break even level. When the takeoff is complicated, your flight is in a safe orbit. If the price continues to move in your favor, you have to protect your paper profits. Paper profit is the real money you can make. So treat it with the same respect as the money in your wallet. Risk only a portion of it as the price of staying in the trade. If you are a conservative trader, apply the 2% rule to your paper profits. Such a product protect profit order is your money stop protecting your equity. If you are an aggressive trader, you may use the 50% rule. As per this rule, of the paper profit is yours while the other half belongs to the market. You can mark the highest high reached in a long trade or the lowest low reached in a short trade and place your stop halfway between that point and your entry stop. For example, if the price moves 10 points in your favor, place a stop to protect 5 points of profit. When you are not sure whether to stay in a trade or not, take profits and reevaluate the situation from the sidelines. There is no harm in exiting and re entering a trade. People think much more clearly when they have no money at risk. In strong trending markets, you can use EMAs as a stops. For a very short term perspective, 2 to 3 days, use 9 EMA as a stop. For a short term perspective, 2 to 3 weeks, use 20 EMA as a stop. For a medium term perspective, 2 to 3 months, use 50 EMA as a stop. For a long term perspective, more than a year, use 200 EMA as a stop. Thank you. Thank you so much. Please subscribe to my channel and like and share.